Welcome to the Deep Dive. You're here because you want to get smart, and you want to get there efficiently without feeling like you've just wrestled a textbook.
Right.
That's exactly what we're up to today.
Oh,
We're diving headfirst into a true legend in the world of investing, Benjamin Graham and David Dodd's security analysis. Think of this as your shortcut to grasping some absolutely fundamental investment principles that can really well make a difference.
that's right. And this isn't just some, dusty old document. It's really the origin point for so many smart investment approaches that actually work today.
Yeah.
We're going to pull out the core, the lasting insights, the things that, as someone looking to navigate the markets effectively, you really need to understand.
And the backstory here is pretty compelling, isn't it? Security analysis was first published after the utter devastation of the 1929 Wall Street crash.
Right after.
Benjamin Graham lived through those losses himself, and that experience, well, it drove him to develop a much more cautious analytical framework for investing.
Exactly. So right away, this isn't just abstract theory. It's built on the bedrock of real financial pain, real experience.
Yeah, that historical context is crucial. Graham wasn't just trying to, make a quick buck. He was trying to create a system.
A system that could shield investors from the kind of ruin he witnessed firsthand. That's why the principles we're going to explore have this built-in emphasis on safety and, thinking for the long haul, which is just as important today, maybe even more so.
Absolutely. And if you're wondering just how impactful this book is, well, consider this. Warren Buffett,
The big wall.
arguably the most successful investor ever, credits this book as absolutely essential to his own journey. I mean, that's about as strong a recommendation as you can get, right?
It really is. Buffett studied directly under Graham and Dodd, and he has consistently pointed to security analysis as the foundation, the bedrock upon which his incredible success was built.
So his whole approach started here.
Well, yeah. While his approach definitely evolved over time, it's deeply rooted in the ideas you'll find right here in these pages.
Okay, so our mission today is pretty straightforward then.
Okay.
We're going to unpack the core ideas of security analysis in a way that's clear and hopefully useful. We want to show you why these principles remain so relevant, perhaps even vital, in today's often unpredictable markets.
Couldn't agree more.
Okay, let's unpack this, starting with a distinction that's absolutely key.
Yeah.
The difference between investing and speculation.
Yeah, Graham and Dodd were very, very precise about this. In their view, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return.
Okay?
Operations not meeting these requirements are speculative. Notice the emphasis there. Thorough analysis, safety, and adequate return.
Those are the key ingredients.
Those are the defining characteristics of true investment in their eyes.
Right. So it's about doing your homework, understanding what you're putting your money into,
Really understanding it.
and having a reasonable expectation of not losing it and making a decent return over time.
Exactly.
Speculation, on the other hand, is more about trying to profit from the short-term swings, right?
Yeah.
The ups and downs in market prices without really getting what's underneath.
Precisely. Speculation is focused on trying to make money from those quick price changes, the fluctuations driven by market sentiment, news headlines, maybe just pure emotion sometimes.
Yeah.
There might not be any real examination of the actual business itself.
It's like the difference between someone who buys a business because they've carefully reviewed its financials, understand how it operates, see its long-term
The
potential,
business owner mindset.
versus someone who just jumps into a stock because they heard it's the next big thing or something.
That's a perfect way to think about it. The investor acts like a business owner, concerned with the long-term stability, the profitability of the actual enterprise. The speculator, though, is more like maybe a gambler, constantly trying to predict the market's next move.
And understanding the difference isn't just academic, is it? It fundamentally changes how you approach things.
Absolutely. It alters how you look at market information, how you manage risk. It's foundational.
Okay, so thorough analysis is fundamental for an investor, and that naturally leads us to another core concept, intrinsic value. What exactly is that in the Graham and Dodd way of thinking?
Intrinsic value, it's the real underlying worth of a business, completely separate from its current price tag in the market.
Okay, so what the market says right now doesn't dictate its true value.
Not necessarily. Intrinsic value comes from a deep examination of the company's fundamentals, its assets, its profits, the dividends it pays out, and importantly, what its future prospects look like.
So it's not just about what other people are willing to pay today for the stock.
Exactly. Graham and Dodd famously recognized that the market, which they personified as Mr. Market, can be pretty irrational.
Ah, yes, Mr. Market.
Mr. Market is like this manic, depressive business partner. He shows up every day offering to either buy your stick or sell you his.
And his mood swings wildly.
Totally. Sometimes he's incredibly optimistic, euphoric even, offering ridiculously high prices. Other times he's deeply pessimistic, maybe panicked, and practically gives shares away.
And here's where it gets really interesting. Because if Mr. Market is so unpredictable, that creates opportunities, right? For the informed investor who has done the work and has a sense of the true worth.
That's the key insight. The market isn't always efficient. Graham knew this. These temporary mispricings, these gaps between price and value, are where diligent investors find their edge.
So you use Mr. Market's moods.
Precisely. When Mr. Market is offering a price significantly below what you've determined the intrinsic value to be, well, that's when a value investor might see a chance to buy.
And the flip side.
Conversely, when the price shoots way above your assessment of intrinsic value, maybe driven by that euphoria, it might be a signal to consider selling.
You used a great analogy earlier about buying a used car. Can you bring that back? It helps make it concrete.
Oh, sure. Imagine you're looking to buy a used car. The dealership slaps a price tag on it, right?
Yep. But a smart buyer doesn't just accept that. You'd inspect the car's condition, check the mileage, maybe look into its repair history.
Do your homework?
Exactly. You'd also research what similar cars are selling for in the market. All of that investigation helps you decide what the car is really worth to you, its intrinsic value.
And sometimes the asking price is way off that value.
Right. Sometimes the asking price is more than your estimate. It's overvalued. And sometimes, maybe you get lucky, it's less undervalued. Same principle applies to stocks.
That makes perfect sense. So how do you actually go about figuring out this intrinsic value? Graham and Dodd must have had some methods.
Oh, they did. And security analysis goes into quite a few in painstaking detail. But conceptually, you can think about a couple of main approaches.
Okay.
One is discounted cash flow, or DCF.
DCF, right.
Heard of that? Yeah. It involves projecting the future cash flows the company is expected to generate, all the cash coming in and out, and then calculating what those future amounts are worth today.
Why today? Because money today is worth more than the same amount of money later due to inflation and opportunity cost. So you discount those future cash flows back to their present value. The idea is the value now is the total of all future cash it'll produce, adjusted.
Okay, that sounds, well, a bit complicated. It relies on making predictions about the future, doesn't it?
It absolutely does, which is why it involves making forecasts and assumptions. It's definitely not an exact science. There's judgment involved.
So what's the other main way?
The other primary method is asset-based valuation.
Asset-based. Okay, tell me more. How does that help?
Asset-based valuation looks at what a company actually owns. It's tangible assets, mainly things like cash, buildings, land, machinery, inventory.
The physical stuff.
Right. You then add up the estimated market value of all these assets and subtract everything the company owes its total debts, like loans, bonds, other obligations.
Okay, assets minus liabilities.
Exactly. What you're left with is the net asset value, or NAV, sometimes called book value, though NAV can try to estimate market value of assets, which might differ from the books.
And that NAV gives you what?
It gives you a baseline idea of the company's worth, almost like what would be left over for the owners if the company were to sell off all its assets and pay off all its debts today.
So it's like figuring out the liquidation value almost.
In a sense, yeah. Think of it like this. Imagine you're having a giant yard sale. You price everything you own, estimate how much cash you could realistically get for it all.
Right.
And then you subtract any money you owe, like credit card bills or whatever. The remainder is your net worth from the sale. For a company, the NAV can act as a kind of floor value, especially for companies rich in tangible assets, or maybe even companies that might be broken up and sold off.
You know, that analogy about a restaurant closing down works well too.
How so?
Well, if a restaurant owner decides to call it quits, they'd figure out the value of their kitchen equipment, the tables, chairs, maybe the remaining food inventory.
Right, the assets.
And then subtract any outstanding bills, rent owed, supplier invoices. That gives them an idea of the underlying asset value they could walk away with.
That's a great example. Or think about a house appraisal. An appraiser looks at the property itself, its condition, comparable sales.
Compares it to others.
Maybe factors in valuable things inside, and then you'd subtract the remaining mortgage balance. That gives you an idea of the net value tied up in those assets.
So the key takeaway here is that intrinsic value, whether through cash flow or assets, gives you a yardstick, a benchmark.
Exactly.
By comparing the market price of a stock to your own estimate of its intrinsic value, you can start to see if it's potentially a bargain or if it's trading at a price that just doesn't seem justified by the fundamentals.
That's the absolute core of it. And once you have that understanding of intrinsic value, the next critical idea from security analysis comes into play, the margin of safety.
Ah, yes, the margin of safety. That sounds pretty important, like an essential layer of protection for your investments.
That's precisely what it is. The margin of safety is the principle of buying securities only when they are available at a significant discount to what you believe their intrinsic value to be.
A significant discount.
Yes. This discount acts as a safety cushion. Think of it as your investment insurance policy against all sorts of unknowns.
Like what kind of unknowns are we talking about?
Well, for one, it protects you if your initial assessment of the company, your intrinsic value calculation, wasn't completely accurate. Remember, it's an estimate.
Right, not exact science.
Exactly.
Yeah.
It also provides a buffer against unexpected negative events that could hit the company or the broader economy, things you just can't foresee.
Black swan events, maybe.
Could be. And it helps you withstand the inevitable ups and downs, the volatility of stock prices without panicking.
So it's not just about thinking a stock is worth $100 and buying it at $95. You're looking for a much wider gap.
Oh, absolutely. Warren Buffett uses a really powerful analogy here.
The bridge analogy.
That's the one. He compares it to designing a bridge. If you calculate that the absolute heaviest load a bridge will ever realistically have to bear is, say, 6,000 pounds,
Okay.
you don't build it to hold just 6,001 pounds. That would be insane, right?
Yeah, cutting it way too close.
You build it with a much, much greater capacity, maybe 10,000 pounds or even more. That extra strength, that huge buffer, that's your margin of safety.
That makes perfect sense visually. So if you calculate a company's intrinsic value to be $100, what kind of discount would Graham and Dodd suggest you look for? Is there a rule of thumb?
Well, there's no single magic number, but applying a substantial margin is key. Maybe 30%, 40%, even 50% wouldn't be unusual for a deep value investor.
Wow.
So in your $100 intrinsic value example, you might only seriously consider buying if the stock price drops to $70 or $60 or maybe even $50 or below.
Wow, that's a really significant difference. What are the main advantages of demanding that kind of buffer?
The advantages are numerous. Like we said, it provides a strong defense against market volatility.
Yeah.
It helps your investments hold up better during economic downturns or market panics.
Reduces risk.
Definitely reduces risk because even if your valuation is a bit optimistic or something bad happens, you have that cushion. It hasn't wiped you out.
Makes sense.
It also encourages you to take a long-term view. You're less likely to be concerned about short-term price drops if you know you bought at a significant discount to begin with.
Takes some emotion out of it.
Hopefully. And ultimately, it increases your potential returns. Because when the market eventually recognizes the true value of the security, the upside from your low purchase price can be substantial.
Can you give us some real-world examples, maybe some famous ones where this principle clearly paid off?
Absolutely. Think about Warren Buffett again. His investment in American Express back in the 1960s.
The salad oil scandal?
That's the one. The company was hit by this major scandal involving fraudulent warehouse receipts for salad oil, of all things. Its stock price just plummeted. Everyone panicked.
Right.
But Buffett looked past the scandal. He analyzed the core business, the traveler's checks, the credit card franchise, and realized the underlying brand and earning power were still incredibly strong.
So he saw value where others saw disaster.
Exactly. He bought shares at a steep discount to what he estimated their intrinsic value to be. He had a huge margin of safety. And that investment, it went on to generate returns of over 4,000% for Berkshire Hathaway.
That's incredible. Any other examples that come to mind?
Well, consider Buffett's initial purchase and eventual transformation of Berkshire Hathaway itself. Back then, it was just a struggling New England textile company.
Not the giant it is today.
Not at all. It was trading for less than its working capital per share, meaning it was incredibly cheap based on its assets. He bought it with a margin of safety, realized the textile business was doomed, and then cleverly used its cash flow to invest in other undervalued businesses. Insurance became key.
And built it from there.
And built the empire. Another classic example is Buffett's investment in Coca-Cola in the late 1980s.
That was happening then.
The stock market had crashed in '87, and Coca-Cola faced some competitive pressures, market worries. But Buffett saw the enduring strength of the brand, its global reach, its pricing power, the economic moat, exactly. He bought a huge stake at a price he considered well below its long-term intrinsic value. Again, margin of safety. And that stock has increased, what, more than tenfold since then, plus dividends.
So it's not just about picking stocks either, is it? This margin of safety principle, it sounds like it applies more broadly.
Oh, absolutely. It's a universal principle for resilience. Consider Ford Motor Company before the 2008 financial crisis.
What did they do?
They had taken steps, including borrowing heavily before the crisis hit, to build up significant cash reserves on their balance sheet. A huge financial margin of safety.
So they had cash when things got tough.
Exactly, and that allowed them to weather the economic storm and fund their restructuring without needing a government bailout, unlike GM and Chrysler.
That's a great business example.
Or think about something operational. Toyota's famous just-in-time inventory system is incredibly efficient, right? Lean manufacturing.
Very lean.
But they also always maintained relationships with backup suppliers. They had redundancy built in, an operational margin of safety. That proved invaluable back in 2011 when the earthquake and tsunami in Japan severely disrupted their primary supply chains.
That's a fantastic point. So margin of safety isn't just a finance term. It's a fundamental principle for building resilience in, well, almost anything. Business, life.
Precisely. And to figure out if that margin of safety exists when looking at a stock, Graham and Dodd stress the critical importance of digging into the financial statements.
Okay, let's delve into that. Financial statements, you've got the balance sheet, income statement, cash flow statement. For someone who isn't, a CPA, what's the basic idea here? Why are they so important?
Think of analyzing financial statements like a doctor giving a patient a thorough medical checkup. Each statement provides a different vital view of the company's financial health.
Okay, different tests for different things.
Exactly. The balance sheet is like a snapshot. It shows what the company owns its assets.
Like cash, buildings, equipment.
Right. And what it owes to others, its liabilities.
Loans, accounts payable.
And the difference between the two, which is the owner's stake in the company's shareholders' equity or net worth, it's all measured at a specific point in time, like December 31st.
So a picture of its financial standing at that exact moment. Got it. What about the income statement?
The income statement is more like a video or maybe a report card showing how the company performed financially over a period, usually a quarter or a full year.
Performance over time.
Yes. It details the company's revenues from sales, subtracts all its various expenses, cost of goods sold, operating expenses, interest, taxes, and ultimately shows whether it made a profit or incurred a loss during that period. It tells you how well the core business is generating earnings.
Okay, revenue in, costs out, profit left over. Makes sense. And the cash flow statement. That one can sometimes feel a bit less intuitive.
Yeah, it can seem tricky, but it's incredibly important. The cash flow statement tracks the actual cash moving into and going out of the company over that same period. Cash is king.
Right. That's what they say.
It's divided into three main buckets. Cash from operating activities, the normal day-to-day running of the business, selling goods, paying salaries. Cash from investing activities, like buying or selling long-term assets, like new factories or equipment, or even other companies. And cash from financing activities, like borrowing money, repaying debt, issuing stock, or paying dividends.
So it follows the actual dollars.
Exactly. It shows the company's real ability to generate cash to run the business, invest for the future, and satisfy its lenders and owners. It's like tracking the company's financial circulation system. For example, a company might show a profit on the income statement, but if its customers aren't paying their bills quickly, the cash flow statement might reveal a problem.
Ah, okay. So by looking at all three statements together, you get a much more complete sort of multidimensional picture than just looking at the stock price or even just the profit number alone.
Absolutely. They work together. And within these statements, there are key financial ratios that investors use to help compare companies and assess their relative value, risk, and efficiency.
Ratios. Okay, can you give us a couple of examples of common ratios that would be useful to know, maybe explain simply?
Sure. A really common one is the price-to-earnings ratio, or PE ratio.
PE. Hear that all the time.
You calculate it by dividing the company's current stock price by its earnings per share, usually over the last year. It gives you a rough idea of how much investors are currently willing to pay for each dollar of the company's earnings.
So higher PE means more expensive relative to earnings.
Generally, yes. A high PE might suggest the market expects strong future growth, while a very low PE could indicate undervaluation, or perhaps that the market sees problems ahead. It's most useful when you compare a company's PE to its own historical range or to the PE ratios of its direct competitors in the same industry. Context is key.
Okay, that's a helpful snapshot of price versus earnings. What's another key ratio people should be aware of?
Another important one, especially for understanding risk, is the debt-to-equity ratio.
Debt to equity. Sounds straightforward.
It pretty much is. It compares the total amount of debt a company has on its balance sheet to the total value of its shareholders' equity. It's a measure of financial leverage, how much the company is relying on borrowed money versus owner's money to finance its assets and operations.
And higher is riskier.
Generally, yes. A high debt-to-equity ratio might suggest the company is taking on more financial risk. If earnings falter, it might struggle to make its debt payments. Lower is usually considered safer. Another one often used by value investors is the price-to-book ratio, PB.
Price to book, what's that comparing?
It compares the company's market price, market capitalization, to its book value, which is basically that shareholders' equity number from the balance sheet. A low price-to-book ratio, say below 1, might suggest that the market values the company at less than its accounting net worth, which could potentially signal undervaluation, especially if the assets are solid. Graham liked looking at this.
Interesting. So analyzing financial statements is really about looking beyond the headlines, beyond the simple stock price, to understand the underlying financial health, profitability, and risk profile of a company.
Exactly. Doing your homework. And as Graham always pointed out, while this thorough research is crucial, you're still making judgments. Your analysis could still be wrong.
Which is why.
Which is exactly why the margin of safety is so vital. It's your protection against being wrong. But even with careful analysis and a margin of safety, there's another huge factor, investor psychology.
Yes, the emotional side of investing, the human element. Graham had some important insights on that too, didn't he?
He certainly did. He famously observed that the investor's chief problem and even his worst enemy is likely to be himself. He also noted, it is difficult to maintain one's logical convictions in the face of excess gloom or euphoria, as reflected in stock prices.
That's so true. Fear and greed.
Absolutely. He understood that the emotional swings of the market, that Mr. Market character again, can be incredibly powerful. They can easily lead investors, even smart ones, to abandon their well-thought-out strategies at exactly the wrong times.
It takes a certain strength of character then, doesn't it? To deliberately go against the prevailing sentiment when everyone else is panicking or getting overly excited.
Absolutely critical. Graham emphasized the necessity for investors to have strength of character in order to think and to act in opposite fashion from the crowd.
Go against the herd.
And also patience to wait for opportunities that may be spaced years apart. Value investing often means being a contrarian. It means buying when others are fearful and selling, or at least being cautious when others are getting greedy and overly optimistic.
And that brings us right back to the Mr. Market analogy. The goal is to use his emotional highs and lows to your advantage, rather than getting swept up in them yourself.
Precisely. The disciplined investor sees Mr. Market's volatility not as a threat, but as a source of opportunity. A chance to buy good businesses at bargain prices when he's feeling irrationally down, and potentially sell things when he's excessively enthusiastic and offering silly prices.
It requires real emotional detachment, focusing on your own analysis, your own estimate of intrinsic value, regardless of the market noise.
That's the ideal. Thinking back to that American Express example, what allowed Buffett to see past the immediate panic during the salad oil scandal when so many others were just dumping the stock?
Yeah, that's a great question. It must have been that disciplined, unemotional analysis Graham advocated, focusing on the long-term earning power, not the short-term headlines.
Exactly. Now, for anyone listening who might be familiar with Graham's other famous book, The Intelligent Investor, how does security analysis compare? It definitely sounds like it's a much more detailed and technical work.
It really is. Security analysis is significantly more technical, more comprehensive. You could almost think of it as the complete recipe book or the textbook.
The deep dive manual.
Yeah, it lays out the specific methods and techniques for valuation and analysis in much greater detail. It really gets into the weeds of how to put Graham's investment philosophy into practice, examining bonds, preferred stocks, common stocks, all sorts of situations, whereas the intelligent investor is more geared towards the individual, perhaps,
Yeah.
more philosophical.
Exactly. The intelligent investor presents the core principles more generally. It focuses on the overall philosophy, buying securities at a discount to their intrinsic value, managing risk, dealing with Mr. Market. It's designed to be more accessible to a wider non-professional audience. It's less of a how-to manual and more of a how-to-think guide.
I've heard that security analysis, especially the earlier editions, is still a standard text in many top MBA programs and finance courses. That really highlights its depth and technical nature.
It absolutely is. It's considered a foundational text for anyone serious about fundamental analysis. And as we mentioned, Warren Buffett credits both books, but security analysis particularly as being crucial to his development. However, it's also interesting to note how even Buffett's own investment style evolved over time, building on Graham but also adapting.
How so? How did it change?
Well, Buffett always adhered rigorously to the fundamental principles margin of safety, intrinsic value that Graham laid out. But over time, he gradually shifted his emphasis somewhat.
From what to what?
Graham's approach, especially early on, often focused heavily on finding statistically cheap stocks, buying companies that appeared very inexpensive based on straightforward metrics like low price to book value or trading below their net current asset value, the famous cigar butt approach, finding discarded businesses with one last puff of value left.
Okay, purely quantitative bargains.
Largely, yes. Buffett, while still always demanding a sensible price, increasingly prioritized the quality of the underlying business itself. He started looking more for excellent businesses with durable competitive advantages, strong brands, network effects, low-cost production that could grow their intrinsic value over time.
Ah, that's where his famous saying comes in, right? It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
Precisely. That quote perfectly captures that evolution. It moves beyond just finding statistical cheapness to also heavily weighing the qualitative aspects, the business's enduring strengths, its management quality, its long-term prospects. It's still rooted in Graham, but with a greater emphasis on quality.
So even the most successful students adapt and build upon the core teachings. That's a valuable perspective, actually. Okay, so bringing it all together now, thinking about today's markets. What are some actionable steps, some key takeaways that an investor listening right now can really grab onto from security analysis?
Well, despite being written decades ago, the core principles are, I think, remarkably relevant, maybe timeless. First, and maybe foremost, always focus on the underlying value of what you're buying, not just the day-to-day price movements.
Value over price.
Make your investment decisions based on a thorough analysis of the company's fundamentals, its earnings power, assets, prospects, not on short-term market trends, tips, or fleeting hype.
Foundational. Don't get caught up in the noise. What's next?
Second, always aim to invest with a significant margin of safety. Don't just pay what you think something is worth. Demand that discount. Seek that buffer. Remember the bridge analogy. It protects you.
Build that extra capacity into your investments. Got it.
Third, cultivate strong emotional discipline. This is maybe the hardest part. Train yourself to think independently and act contrary to the prevailing market sentiment when your analysis justifies it.
Be brave when others are fearful.
And cautious when others are euphoric. Easier said than done, of course, but absolutely essential for long-term success in value investing.
Agreed. It requires real mental fortitude, real discipline. What else?
Fourth, commit yourself to conducting thorough research. Do the work. Take the time to actually analyze the financial statements, really understand the company's business model, figure out its competitive position before you put your hard-earned capital at risk.
Don't just rely on headlines or someone else's opinion.
Exactly. Do your own homework. Be responsible for your own decisions based on facts and analysis.
Solid, practical advice. Keep going.
Fifth, adopt a long-term perspective. Value investing is usually not a get-rich-quick scheme. Identifying genuinely undervalued securities and then waiting for the market to recognize their true worth often requires significant patience.
It's a marathon, not a sprint.
It really is. Patience is a critical virtue for the value investor. Sometimes the market takes years to correct a mispricing.
Absolutely. Maybe one final takeaway.
And finally, consider diversifying your investments appropriately. While Graham himself, being highly skilled, sometimes advocated for concentrating on his highest conviction, most deeply undervalued ideas for most individual investors.
Yeah, for us mortals.
A reasonable level of diversification across different companies, maybe different industries, can be a very prudent way to manage risk. It helps ensure that if one of your analyses turns out wrong, it doesn't cripple your whole portfolio. Diversification combined with a margin of safety is powerful.
That's all incredibly valuable guidance. It really strikes me how, even in today's incredibly fast-paced, information-saturated markets, these fundamental principles from security analysis still offer such a solid, time-tested framework.
They absolutely do. It's a disciplined approach that cuts through the noise. Developing your own ability to estimate intrinsic value and consistently applying that principle of margin of safety are just critical skills for any investor who wants to make smarter, more informed decisions and aim for durable, long-term success.
This has been a really insightful deep dive. It forces you to shift your perspective, doesn't it? To see the market not just as this flickering screen of prices, but as representing fractional ownership in real businesses with real underlying value.
That's the fundamental shift, isn't it? That's what security analysis really aims to instill. Moving from being a market speculator, reacting to every blip, to thinking and acting like a part owner of a business.
So for you, our listener, as you navigate your own investment journey, maybe take Graham's wisdom to heart. Think about his distinction between the market in the short run and the long run.
The voting machine versus the weighing machine.
Exactly. In the short run, the market's like a voting machine, tallying up popularity contests based on fear and greed. But in the long run, it's like a weighing machine, ultimately assessing the substance, the true underlying value of a business. Maybe you focus more on the weighing machine in your own decisions.
Well said. And if this discussion has sparked your interest, you might find it really beneficial to explore Graham's more accessible book, The Intelligent Investor, as a next step.
Good suggestion.
Or perhaps to really dig deeper into learning specific techniques of financial statement analysis. There are tons of resources out there to build those practical skills.
Excellent suggestions to continue the learning journey. Thanks so much for unpacking all that today.
My pleasure. It's foundational stuff.
It really is. Thanks everyone for joining us for this deep dive. Until our next exploration.